Hi, this is Jessica Dunn, and we are going to be working through Chapter 8, which is about risk and return tonight. Most decisions involve two considerations. One is the return that you will earn, and the other is the risk that you are exposed to. Every financial decision is going to contain some amount of risk or return. And one thing we have for sure learned in this class, and tonight we'll be reiterating that, is that the greater the risk, the greater the expected return. So the more risk that you're exposed to, the greater the return should be. There are a lot of different ways to quantify risk depending upon whether you're looking at assets in isolation or in a portfolio. A portfolio is simply a collection or a group of assets. And we're going to look at several different techniques. Risk is simply a measure of uncertainty. So, how certain are you that the condition that you expect will occur? So, the uncertainty surrounding the return of an investment, the variability of returns associated with an asset. So, what is the likelihood that you will receive what you're expecting? Return is the total gain or loss experienced on an investment over a given period of time. It can be calculated in dollar terms or percentage terms. And we're simply taking the asset's cash generation plus any change in value divided by the purchase price of the asset. And if it sounds too good to be true, it probably is. And here are some examples. Everyone has heard of Bernie Madoff. He generated high returns year after year with seemingly no risk. On December the 11th, 2008, the SEC charged Madoff with securities fraud. It turned out to be a giant Ponzi scheme. So if there are very, very high returns with very little perceived risk, then one should naturally be cautious of the investment because large risk equals large return. You can't usually get large returns unless you're willing to risk some of that capital. So here's the expression that we use for calculating the rate of return on any asset over a time period. And here we see that the return is equal to the cash flow that you receive from the investment over the period plus the sale price minus the purchase price divided by the purchase price. So I put that into common terms. So the total return, R sub T, that's the return during the period of time period T. C sub T, that is the cash flows that you're earning. So when we're talking about stocks, we think about dividends. So your dividend payments plus the price at the future point in time minus the price at the beginning point in time divided by the price at the beginning point in time. So I think it's easiest if we just jump in here and do an example. We can calculate the annual rate of return for each stock, and we have Apple and Walmart. And again, these are made up numbers, so they are not representative of actual market values. So at the beginning of the year, Apple stock traded for $90.75, which I know Apple's trading for much more than that. Walmart was valued at $51. During the year, Apple paid no dividends, but Walmart shareholders received dividends of $2.10 per share. At the end of the year, Apple stock was worth $92.11 and Walmart was worth $50. So let's calculate our return on each of the stocks. So let's start with Apple. With Apple, we received no dividends. So if we're looking at our equation here, our equation said that the return on the stock is equal to the cash flow or the dividends received plus the purchase price or the sale price or the ending price minus the price at the beginning of the period divided by the price at the beginning of the period. So with Apple, there were no dividends, so the cash flow is zero. But we did see stock price appreciation. So at the end of the year, the stock was worth $92.11. at the beginning of the year was only $90.75. And we divide by the price at the beginning of the period. And that gets us 1.5%. So now let's do the same thing for Walmart. Walmart did pay dividends. It paid dividends of $2.10 per share. At the end of the year, it was worth $50, and at the beginning of the year, it was worth $51. So it had a decline in the stock price throughout the year, and we divide by 51, and that gets us 2.2%. So Apple had a return of 1.5%, and Walmart had a return of 2.2%. This is interesting because Walmart's share price actually declined while Apple's rose. But because of the dividend, the cash distributions, the return on the Walmart was greater than return on Apple. So that's a simple way to measure risk. But what about standard deviation? Standard deviation is a good way to measure the risk of a single asset. So this is an asset in isolation, and we can use standard deviation to look at the variability of the expected. So how likely are we to receive what we expect? So before we can work with standard deviation to determine the risk of this asset, we need to first determine how much we actually expect. So that's the first logical question. What is our expectation? So the expected value, or the expected return, which we can write like this: the expected return of an asset is equal to the summation of the returns in different scenarios times the probability of that scenario occurring. So the expected return, which can be written as E open parentheses R close parentheses, or R with a bar over it, that's the same thing. The expected return is equal to the summation of the return in a specific scenario times the probability of that scenario occurring. And we're going to do several examples. So scenario analysis is an approach for assessing risk that uses several possible outcomes or scenarios to obtain a sense of the variability in the returns. So the most common way to do this is to consider three different scenarios: one pessimistic, one the most likely scenario, and one in the most optimistic outcome. So what's going to happen in the worst scenario, what's going to happen in the best scenario, and what's most likely to occur. And then we give probabilities for those outcomes. So here's an example. Norman Company's past estimates indicate that the possibilities of the pessimistic, most likely, and optimistic outcomes are 25, 50, and 25%. So we have a 25% chance of a bad outcome, a 50% chance that we'll have an average or most likely outcome, and then a 25% chance that things will go really, really well. And in the event that things do go really well, we expect asset A to have a 13% rate of return and asset B to have a 7% of rate of return. In the most likely scenario, we see that asset A and asset B have a 15% rate of return. And in the optimistic scenario, which we see a 25% chance of the optimistic scenario occurring, asset A has a 17% rate of return and asset B has a 23% rate of return. So the first thing to note here is that the outcome probabilities have to sum to 100%. So we have to be looking at every possible outcome. So 25 plus 50 plus 25 is 100%. So let's calculate our expected returns for these assets. And we said that our expected return is equal to the summation of the return in that scenario times the probability of that scenario occurring. And so with this, we can see that the expected return of asset A is equal to the rate of return in the pessimistic scenario, which is 13%, times the probability of that scenario occurring, which is 25%, plus the rate of return in the most likely scenario, 15%, times the chance the most likely scenario will occur, 50%, plus the rate of return in the optimistic scenario, 17%, times the probability of the optimistic scenario occurring, 25%. So we multiply those and add them up, and we see that our expected return for asset A is 15%. We can do the same thing for asset B. The expected return for asset B is equal to the return in the pessimistic scenario times the likelihood of the pessimistic scenario plus the return during the most likely scenario times the probability of the most likely scenario occurring. And then we do the same thing for the optimistic scenario. And we also get a 15% expected rate of return for asset B. So we see that asset A and asset B, they both cost the same. They both cost $10,000. And they both have the same expected return. So given that information, should we care which asset that we purchase? Sure we should. We should be looking at the risk of the assets. We should be investing in the asset that poses the least amount of risk because they have the same amount of return. And so to do that, we could use some very fundamental, some very simple measures of risk. We could look at the range. So the range of returns for asset B is 4%. And all you do is take the highest observable return minus the lowest observable return, and you get 4%. We can do the same thing for asset B. The highest observable return is 23%, and the lowest is 7%. That gives us a range of 16%. So even looking at a very remedial measure of risk, such as range, we see that asset B is substantially more risky than asset A. Usually it's not quite so easy to make this determination. It's very unlikely that you're going to have two assets that have the same expected return. So sometimes we need to do a more complicated analysis, but let's just stick with this for the time being. So here are historical returns on selected investments, and this helps us to see how our risk and return are related. Treasury bills usually have a maturity of 1 year or less, while the Treasury bonds have maturities upwards of 30 years. And so that makes them a bit more risky because of interest rate changes. So Treasury bills are going to be less risky than Treasury's bonds. And so looking at that, we see that Treasury bills have a much smaller rate of return than Treasury bonds. So you're being compensated for that risk that you're bearing. Let's compare that. Treasury bills and Treasury bonds both have essentially no default risk. And so we're only concerned about fluctuations in interest rates when comparing these two, and we still see a difference in returns. We see that Treasury bonds price that risk. Common stocks are much more risky than either Treasury bills or Treasury bonds because there is the chance of default. So with common stock, the average nominal rate of return between 1900 and 2009 was 9.3%, which is a substantially higher rate of return than either Treasury bills or Treasury bonds. So the greater the risk, the higher the return. Economists use three different categories to describe how investors respond to risk. Risk averse, this is what most people fall in. Risk averse, this attitude describes the behavior of most people most of the time. And most people prefer less risk to more risk. So we prefer to avoid risk. If we are going to take on any risk, then we must be compensated for doing so. So by taking on an additional unit of risk, we must also take on an additional unit of return because we are risk averse. We don't love risk. We don't chase after it. To bear risk, we must be compensated for it. Risk neutral. This is where the investor chooses the investment with the highest return regardless of its risk. So you don't care how risky it is. You simply are chasing the highest return. It doesn't describe most of us, right? Risk seeking. This is where investors prefer risk. They don't care what the return is. They want the highest level of risk. So we do act in a risk-seeking behavior sometimes. Otherwise, Las Vegas wouldn't exist because we know going in that most likely we are going to lose money when we go to Vegas. And yet we go anyway. So we do act in risk-seeking behaviors at times, and we do act in risk-neutral behaviors at times. But most of the time, most people are risk averse. And when we're talking about this, we're really talking about your real money, that money that you need to pay your groceries, to keep your lights on, to pay your mortgage. We're not necessarily talking about the extra money that you have at the end of the day that you might go buy a scratch off with. We're talking about that money that you need to survive. So scenario analysis allows us to identify possible outcomes and to attach a probability of those outcomes occurring to see what the variability is amongst our returns. Range is a very simple measure of risk, which is simply found by taking the return in the worst outcome and the return in the best outcome and seeing what the difference is. And so here we just talked about that. We said that both asset A and asset B had an expected return of 15%, but asset A has a range of 4%, while asset B has a range of 16%. So asset B is the more risky of the assets. Range is very unsophisticated, and there are a lot of more accurate methods that require some basic statistical skills. So probability is the chance that a given outcome will occur. A probability distribution is a model that relates probabilities to their associated outcomes. There are different types of probability distributions. A bar chart is the most simple type of probability distribution, and here it's only showing a limited number of outcomes and the probabilities associated with those outcomes. A continuous probability chart is going to show 100% all possible outcomes and the probability of each event occurring. If we are to look at the returns for asset A and asset B, we see that in the example given, we were given 3 scenarios. So we weren't giving every single possible scenario that could ever happen because, in reality, we could land somewhere between the most likely scenario and the optimistic scenario. So we were given bar chart information. The bar chart says that in the pessimistic scenario, we had a 25% chance of that occurring, and we would see a 13% return. In the most likely scenario, we had a 15% chance, or 15% return, and a 50% chance of that occurring. If this were a probability chart, then we would be looking at a continuous line instead of the peaks. But whenever we look at, so the the continuous line is showing us a continuous probability distribution. The bars are the bar chart distribution. But looking at this, we can see that the range for asset B is much greater than the range for asset A. And we see that because of the shape of the probability distribution. When we look at this line, we see that for asset B, it's very flat. It does peak, but the tails are very thick. And so that tells us that there are a lot of observations that are not close to the mean. So there's a large chance that you're going to earn something other than what you expect. Because remember, we expect to earn the mean. We expect to earn 15%. And here, there's a large chance that you're going to earn something other than what you expected. With asset A, we have a very tight distribution. We see that it's very peaked. The tails are very thin. That's telling us that most of the observations are concentrated around that expected return. So we're going to get what we expect, or we're going to get very close to what we expect with asset A because the range is much smaller. So here, let's look at this again. We have two assets. We have asset C and asset D. This is a continuous probability distribution. Notice there's no single lines there. We see that asset C has a much steeper curve. The steeper curve tells us that asset C is less risky than asset D. It's less risky than asset D because more of the observations are concentrated around the mean. With asset D, there's a large chance they're going to get something other than what you expect because the peak is very small. It's not a very tight distribution. Seemingly improbable or even impossible events are more likely to occur than people believe, especially in the field of finance. So here's an example of the black swan. Is it ever possible to know for sure that something can never happen or that its chance of occurrence is zero? In 2007, the black swan, it's argued that impossible or even improbable events are more likely to occur than most people believe, especially in finance. This book's title refers to the fact that for many years people believed that all swans were white until there was a black variety discovered in Australia. So this correlates very, very closely to the financial crisis. No one believed that the financial markets would plummet, that the housing markets would crumble, and yet they did anyway. A more sophisticated measure of risk would be standard deviation. This is a very common measure of risk. It's measuring the dispersion around the expected value. And to calculate standard deviation, the standard deviation is equal to the square root of the summation of the return in each state of the economy. So we were talking about pessimistic, most likely, and optimistic scenarios. That was the return in each state minus the expected return, that 15% for A and B that we had calculated. We square the difference and multiply by the probability of the event occurring, which would be the events are pessimistic, most likely, and optimistic scenarios. The higher the standard deviation, the greater the risk. So let's calculate the standard deviation for assets A and B. The formula for standard deviation is the square root of the summation of the return in each scenario minus the expected return, square the difference, and multiply by the probability of occurrence. So let's calculate the standard deviation of asset A. I'm going to draw my square root last only because I don't know how big my my calculations are going to be, and I want to make sure I cover the whole thing. So in the pessimistic scenario, we see a 13% return, and we subtract from that our 15% expected return that we previously calculated. So on a previous slide, we found that the expected return of asset A was 15%. Square the difference and multiply by the chance of happening, which was 25%. Then we move on to the most likely scenario. We see a 15% return, and we multiply that by the 50% chance of occurrence. Oh, sorry. I wrote that backwards, didn't I? Let me erase that. In the most likely scenario, we saw a 15% return. We subtract from that our 15% expected return, square the difference, and multiply by the chance of the most likely scenario happening. Then we move on to the optimistic scenario. We see the optimistic scenario has a 17% return, and we subtract from that our 15% expected return and multiply it by the probability. And don't forget that we took the square root of the whole thing. So when we do that, I got .41%. So on your calculators, there's going to have to be, if you have a graphing calculator, you can type it in as written. But if you don't, then there's going to be a lot of writing numbers down and then going back and adding it up. So we take the difference and we square it. To square it, you use the button above the open parentheses, or the closed parentheses, excuse me, and then multiply that by 0.25. So we get 0.001. 15 minus 15% is 0, so that's going to cause that entire part to be 0. And then we have 17 minus 15%. Square that and multiply by 0.25. So we get 0.001 again. Oh, that's 3 zeros, excuse me. This was 3 zeros. And we're going to take the square root. So multiply that by 2, because 0.0001 plus 0.0001. That's all I did there. And we take the square root, which is above the open parentheses button, and we get 1.41%. So there's quite a bit of room for error here if you're having to write things down and then go back and add them up, and a lot of places where you can forget. So you do need to practice this a bit before you get to the exam. There are several practice places on Canvas. Let's go ahead and calculate the standard deviation of asset B. Remember that the expected return that we already calculated was 15%. The standard deviation, remember we said the formula for standard deviation was equal to the summation of the return minus the expected return squared times the probability. So the standard deviation of asset B, in the pessimistic scenario, we see a 7% return. We subtract from that our 15% expected, square the difference, and multiply by the chance of occurrence. Most likely scenario, we see a 15% return, subtract it from the expected return, square it, and multiply by the chance of occurrence. Optimistic scenario, we see a 23% return, subtract from that our expected return, square the difference, and multiply by the chance of occurrence. and take the square root of the entire thing. And you should get 5.66%. Feel free to pause the lecture as you're trying to work through this and make sure that you do get the 5.66%. So we've already talked about how risk and return are related. We said that we talked about conceptually how Treasury bonds are more risky than Treasury bills, and common stocks are more risky than either of those, and their return is commensurate of that. We can also look at their standard deviation. We can see that Treasury bills have the lowest standard deviation, while common stocks have the highest standard deviation. Investments with higher returns usually have higher standard deviations. This affirms that most people are risk averse, that they demand to be compensated for taking on additional risk. The coefficient of variation is something that we're going to talk about in a minute, but it's simply a single number that allows you to make a comparison. It's standard deviation divided by the expected return. So we're going to talk more in depth about that in a minute. Stocks are riskier than bonds because, remember, bonds, they may be secured. They're going to be senior to common stock in the event of financial distress or bankruptcy. But some stocks are riskier than others. A recent study found that returns on large stocks was 11.8%, while small stocks earned 16.7%. So the higher returns on small stocks did come with the cost. The standard deviation on those small stocks was significantly higher than the standard deviation on large stocks. So not all stocks are just the same. Some stocks are going to be more risky than other stocks. The probability distribution for a stock can be approximated with the normal probability distribution. In reality, stocks are not 100% normal distributions. In reality, they do have a bit thicker tails, a little bit higher peaks, but using this other distribution makes things so much more complicated, and it's not that much more accurate. So most researchers just use the normal probability distribution when looking at stocks. But the probability distribution here gives us some insight. It allows us to determine the amount of observations that fall within standard deviations. So we see that 68% of observations lie within one standard deviation of the mean. 95% of observations lie within 2 standard deviations of the mean, and 99% of all observations lie within 3 standard deviations of the mean. So we could use this to calculate confidence intervals. If we wanted to be 68% confident, then we would look at our mean, add or subtract 1 standard deviation, and we would be 68% confident that our returns would be within that number. So if we were looking at our example here, we had an expected return of 15%, and our standard deviation was 5.66%. So 15% plus or minus 5.66%. So 9.34 would be the bottom, and 20.66 would be the top. So 68% of our observations would fall between 9.34 and 20.66%. If we wanted to be 95% confident, then we would look at our expected return plus or minus 2 standard deviations. So 15% plus or minus 2 times the 5.66%. Oh, I don't know what happened. So if we did 15 minus 2 times 5.66, we would get 3.68. And then we get 26.32. So we see that this stock has a large standard deviation. These are a lot of variability, a lot of variation in our expected return. We see that asset A has a very small standard deviation. So if we were to calculate the confidence intervals for our asset A, they would be much tighter than they are for asset B. So this would tell us we were 95% confident that our observations would fall between 3.68 and 26.32%. The coefficient of variation is a measure of relative dispersion, and this allows us to compare the risk of assets. So it's very difficult for the human brain to make comparisons. That's why we get so confused when trying to find ketchup at Walmart, because they have 4,000 different kinds. Barbecue sauce is even a better example. They have half a row at Walmart devoted to barbecue sauce with 100 different flavors and 100 different brands. It's like nearly impossible to find anything that you're wanting, much less try to find which one's the best price, which one's the best value. So our brain is very, very difficult when we start trying to make comparisons. And so with our previous example where both of the stocks had an expected return of 15%, the comparison was very easy because we were only having to compare standard deviation. We knew what the expected return was. We were only making one comparison. If the expected returns weren't the same, then we would be analyzing and trying to compare both expected returns and standard deviations and trying to determine which one of these gives us the best value or the best bang for our buck. Coefficient of variation allows you to take both expected return and standard deviation together in one measure to make one single comparison. It's simply looking at standard deviation divided by expected return. A higher coefficient of variation means that there is more volatility. So a higher coefficient of variation is bad. It's the risk per unit of return. So let's calculate the coefficient of variation for assets A and B, the same ones we've been looking at. The expected return of asset A was 15%. The expected return of asset B was also 15%. And these are things we've calculated before. So if you just picked up here, if you took a break, remember that I'm not just pulling these out of thin air. We have been working with the same example. The standard deviation of asset A is 1.41%. And the standard deviation of asset B is 5.66%. So we're going to calculate the coefficient of variation, which is the risk per unit of return. Higher is bad. So let's calculate the coefficient of variation for asset A. The standard deviation is 1.41%. The expected return is 15%. And we get 0.094. For asset B, our standard deviation is 5.66%, and our expected return is 15%. And so that's 0.377. Higher is bad, higher is worse. So this tells us that asset A is better because it has less risk per unit of return. In real-world situations, however, investors don't care, or they don't put a lot of weight on the risk of a single asset. Usually we care about how that asset impacts our portfolio. The goal is to create an efficient portfolio, one that maximizes return for a given level of risk. And so to do that, we need to look at the return of our portfolio versus the risk of our portfolio. So let's first calculate the return of our portfolio. The return of our portfolio is simply the weighted average of the returns of the individual assets within the portfolio. So the portfolio return is equal to the weight in the asset, so the percentage of our portfolio devoted to that asset, times the return on that asset. And we sum that up for every asset within the portfolio. So the weights times the returns for each asset. Now, one thing to note here is that the sum of the weights must equal 1. So we're looking at 100% of our portfolio. So let's look at an example here. James purchases 100 shares of Walmart at a price of $55 per share. His total investment then is $5,500. He also purchases 100 shares of Cisco at $25 per share. So the total investment in Cisco is $2,500. So his entire portfolio value is $5,500 plus $2,500, $8,000 is the value of our entire portfolio. So the first thing we need to determine is the weights. We need to know what is the weight in Walmart and what is the weight in Cisco. The weight in Walmart, he has $5,500 invested in Walmart. Divide that by 8,000, his entire portfolio. And that tells us that he has 68.75% of his portfolio invested in Walmart. He has $2,500 invested in Cisco, which is 31.25. Now we know that the weight in Walmart and the weight in Cisco must equal 1. So another way to have gotten the 31.25 would have been simply to have taken 1 minus 68.75. Either way, you get the same answer. But the main thing is that we're looking at 100% of the portfolio. So let's calculate the expected return of a portfolio where 50% of our portfolio is invested in asset X and 50% is invested in asset Y. So we need to have our portfolio returns. We see here that if we have 50% in asset X and we have 50% in asset Y. So a 12% return. Let's do the same thing for each year. 10%, 50% in it, and 50% of our portfolio in asset Y. This is a 12% return. Here it's going to be 12% obviously because they both have the same. You can do the math on each of these, but you're going to get 12%. So to calculate the expected return of our portfolio then, we would simply take 12% plus 12% for 5 years and divide by 5 to give us 12%. Now, if we wanted to calculate the standard deviation, we know that the expected return of our portfolio in each of these years is 12%. We know our return for each of the assets. One thing to note here, though, this is not the entire population. This is a sample, so we need to use the formula for sample standard deviation. This will not be on your test. Repeat, this will not be on your test. In -1. So if you're doing a sample standard deviation, this is the formula, and this is just to kind of show you how the standard deviation works. So we take our return, which in each state of the economy is 12%, our portfolio 12%, our expected return is also 12%, square the difference, and we do this for every state of the economy, which obviously is going to be 12 minus 12 in each of these. And divide by 5 minus 1, or 4, and we get 0. So there's no risk here. There's no risk here because these assets are moving opposite one another. As asset X is increasing in value, asset Y is decreasing in value. And so those are offsetting one another. And that is best seen through correlation. So the reason for the last two slides was to get us to the idea of correlation. That even though we have assets that don't have the same exact return, we can eliminate risk. We can achieve standard deviations of 0 because the assets are moving opposite one another. As X is increasing in value, asset Y is decreasing in value. So correlation is measuring the relationship between two series of numbers. So it's telling us, are they moving together or are they moving apart? Are they moving together or opposite? Positively correlated means that two series move in the same direction. Negatively correlated means that they move in opposite directions. So the correlation coefficient can lie between a positive one or a negative one. A positive one means that two assets are perfectly positively correlated. That means that they're moving together 100% of the time. When one increases, the other increases. When one decreases, the other decreases, and by the same magnitude. Perfectly negatively correlated means that the correlation coefficient has a -1, and it means the assets are moving in opposite one another. So when one asset is increasing, the other is decreasing, and at the same rate. So here this is presented in a picture. Here we see perfectly positively correlated assets. They're both increasing together, decreasing together, increasing together, decreasing together. Perfectly negatively correlated assets are moving opposite one another. When one's decreasing, the other's increasing. When one's increasing, the other's decreasing, and by the same rate. So when we look at this, we see that when you're looking at the returns of assets that are moving opposite one another, when one's increasing and the other's decreasing, and then one's decreasing and the other's increasing at the same rate, they're canceling each other's movements out. And so that gives us a straight line. So whenever you cancel out the upward swing with the downward swing, we're getting a constant return over time. When things are perfectly positively correlated, there is no risk elimination. They're moving together. We see and feel every single change in returns because there is nothing there to offset it. We have nothing moving opposite. Most assets are not perfectly positively related or perfectly negatively correlated. They're somewhere in between. So we may have one asset looks like this. We have another asset that looks like this. So yeah, maybe they're moving in the same general direction, but one is moving much faster than the other. One's a little bit lazier. One's much more reactive to the market. So that's not perfectly positively correlated, but it's not perfectly negatively correlated either. To reduce overall risk, it is best to diversify. And to diversify, we need to add assets that have the lowest possible correlation to our portfolio. So in an ideal world, we would combine assets that were perfectly negatively correlated because then we would have no risk. But since it's very difficult to find assets that are perfectly negatively correlated, we want to choose assets that have the least or the lowest correlation possible. This helps us to reduce the overall variability of our portfolio's returns. If assets are uncorrelated, it means that they have absolutely no interaction and they're both making movements that are not related to one another, so their correlation coefficient is close to zero. So here we are. Let's look at asset F and asset G. Asset F and asset G, they both have about the same level of range. Their range is about the same. Whenever we look at range, we're looking at the top to the bottom. Top to the bottom. It's about the same. The width of those two, the difference between the peaks and the valleys are about the same for both of them. Their average return is also the same. They have the same expected return. But whenever we combine these two assets, they're not perfectly positively correlated. They're not moving together. And they're not perfectly negatively correlated. It looks like they're moving kind of opposite one another, but not perfectly opposite one another. They're not exact replicas in opposite. And so when we combine these two assets, we see that the range, which is our most simplistic measure of risk, is much smaller. We still have the same expected return because when we combine the assets, our expected return doesn't change. It's just the weighted average of the individual securities returns. But our risk is much, much tighter. We have much less risk because the not perfectly positively correlated allows us to reduce some variability in our returns. Let's consider two assets, low and high, and they have these characteristics. Asset low has an expected return of 6% and a standard deviation of 3%. Asset high has an expected return of 8% and a standard deviation of 8%. The performance of the portfolio that combines both low and high does not depend solely upon the expected return. It also depends upon how the assets are correlated. Regardless of the correlation, regardless of how these assets move together, we are always going to achieve a return between 6 and 8%. Because low's expected return was 6 and high's expected return was 8%. So we're always going to be bounded by that. If you invest 100% of your portfolio into asset H, then you're going to have a return of 8%. If you invest 100% of your portfolio in asset low, then you're going to have a return of 6%. So no matter the combination, you're always going to have returns between 6 and 8%. Now, when we look at the risk of the portfolio, that is dependent upon the correlation of the assets. So if the assets are perfectly positively correlated, meaning they move together all the time in the same magnitude, then we see the standard deviation for low is 3% and for high is 8%. It will always be bounded by 3 and 8% if they're perfectly positively correlated. If they're uncorrelated, we can see a little bit of risk reduction. We see that with the right combination of the assets, we can have a standard deviation for the portfolio that is less than the standard deviation of either low or high in isolation. If we have perfectly negatively correlated assets, if low and high are perfectly negatively correlated, then we can create a portfolio with no risk. But the important takeaway here is that as long as these assets are not perfectly positively correlated, we can achieve standard deviations below either the standard deviation of low or the standard deviation of high in isolation. We can also include international companies into our portfolios to further reduce risk or to further diversify. If we can include assets from countries whose business cycles are not highly correlated with the U.S., then we are reducing our portfolio's responsiveness to market movements. Over long periods of time, internationally diversified portfolios perform better. Over just a 1 year or two period, there's not any conclusive evidence. The capital asset pricing model is the basic theory that links risk and return for all assets. The capital asset pricing model quantifies the relationship between risk and return. It measures how much additional return an investor should expect from taking a little extra risk. So total risk is the combination of a security's non-diversifiable and diversifiable risk. Diversifiable risk, which is also called unsystematic risk, is risk that is attributable to firm-specific actions. These actions, this diversifiable risk, can be eliminated through diversification. So examples of diversifiable risk. This would be a strike, a product recall, layoffs. These are all things that affect specific companies. Non-diversifiable risk, this is also called systematic risk, is not diversifiable. You cannot eliminate it through diversification. Examples of non-diversifiable risk, economic events, war, COVID-19 that we're experiencing now. These are all examples of non-diversifiable risk. And because any investor can create a portfolio of assets that can eliminate diversifiable risk, we only care about non-diversifiable risk. So when we're looking at our portfolio, we have our total risk, which is the blue line, and we see that this imaginary line here in the center. This is an imaginary line right here. It's where this total risk approaches this horizontal line, this asymptotic line. And we see that everything above this imaginary line is going away. And it's going away as we add assets to our portfolio. So as we make our portfolio larger, our diversifiable risk is falling. It approaches this invisible line here, and everything below that we call non-diversifiable risk. It's the risk that doesn't go away, despite the number of assets in your portfolio. Now, historic studies have said that the ideal number of stocks in your portfolio is around 20 or so, because beyond that, any benefits that you receive because of diversification are eaten up by transaction costs, so the cost of buying and selling stock. I am not aware that there have been any additional studies done since we've had zero commission trades introduced through Robinhood. So I'm sure that number is changing, but I don't know what the new research studies have said about the ideal portfolio size to eliminate diversification. I'm sure that now that we have no monetary cost, there is still cost of having additional stocks in your portfolio. You still need to do your research and your homework, your time cost, your education cost, your knowledge, the amount of time you want to devote to managing your portfolio. But monetarily, I don't know what the new recommended numbers are since this introduction, and I am not aware that there have been any studies completed as of yet. The beta coefficient is the measure of non-diversifiable risk. So we're going to use beta to measure non-diversifiable risk. The beta coefficient for the market is 1. All other betas are viewed in relation to the market beta of 1. The market return is the return of the market for all traded securities. And so here's how we derive our beta. We plot our asset returns against the market. We find the line of best fit, and the slope of the line of best fit gives us our beta. And so this is just a regression equation. We're finding the line of best fit and finding the slope of that line, and that tells us our beta. Now, a beta of 1.3, as in this example here, means that this stock moves in the same direction as the market because it's positive, and it's more responsive than the market. 30% more responsive than the market. The 0.3 is what tells us that. So assets with a beta of greater than 0, they're positive, then they move in the same direction as the market. The magnitude of that number tells us how responsive it is. So if it's 0.5, it's half as responsive as the market. If it's 1, it's the same as the market. Because remember, we're viewing everything in relation to that number 1 place. A beta of 2 means it moves in the same direction, but is twice as responsive as the market. Now, if it's a negative number, it means it's moving opposite. So a negative 2 means that it's moving opposite to the market and it's twice as responsive. Here are some betas of some popular companies. We see that, Anheuser-Busch has a beta of 1. It moves in the same direction of the market, is just as responsive. Ford has a beta of 2.72. Now, this is in 2010, so keep in mind the economic climate of the time. But it moves in the same direction and is 270% more responsive than the market. If we wanted to know the beta of our portfolio, it is simply the weighted average of the individual betas within the company. The weighted average of the individual company betas. So it's the summation of the weight times the beta of each company. Now again, those weights have to sum to 1. We're looking at 100% of our portfolio. So here's an example. We have portfolio V and portfolio W. Let's calculate the beta for portfolio V. Remember, it's the summation of the weight times the individual security's beta. Okay, so we see that the weight for asset 1 is 10% and has a beta of 1.65. Asset 2 has a weight of 30% and has a beta of 1. Asset 3 has a weight of 20% and a beta of 1.3. Asset 4 has a weight of 20% and a beta of 1.1. Oh, that's a multiply there, multiply. Asset 5 has a beta of 20% and has a beta of 1.25. If we multiply these out and add them up, then we get a portfolio beta of 1.2. Now we could do the same thing for portfolio W. Asset 1, 10% with a beta of 0.8. Asset 2, 10% with a beta of 1. Asset 3, 20%, beta of 0.65. Asset 4, 10% with a beta of 0.75. And asset 5 has 50% weight with a beta of 1.05. Now, one thing to note, our weights did sum to 1, but the beta of portfolio W is 0.91. So portfolio V is moving in the same direction as the market, and it's a bit more responsive. Asset W is moving in the same direction and is less responsive because we're comparing it to the market beta of 1. So using this beta coefficient, we can use this to look at the relationship between risk and return using the capital asset pricing model. So the capital asset pricing model says that the return on an asset is equal to the risk-free rate of return plus beta times the market risk premium. The market risk premium is equal to the market return minus the risk-free rate of return. So this is important because sometimes a problem will tell you what the market risk premium is, and sometimes they'll give you the market risk and the risk-free rate of return in isolation. So you need to be aware that the market return minus the risk-free rate of return is the market risk premium. The risk-free rate of return is usually the 3-month T-bill. It's the required return on the risk-free asset. And the market risk premium is the market return minus the risk-free rate of return. So it's the market's return minus this risk-free rate of return. So let's do an example. The CAPM says the return on an asset is equal to the risk-free rate of return plus beta times the market risk premium. So Benjamin Corporation wants to determine the required return on asset Z. It has a beta of 1.5, the risk-free rate of return is 7%, and the market portfolio is 11%. So to calculate the required return for asset Z, the risk-free rate of return is 7%. The beta is 1.5, market return is 11%, and risk-free rate of return is 7%. And so multiplying that out, we find that the required return for asset Z is 13%. It's showing us the relationship between this non-diversifiable risk and our required return. So how much return are we required to receive because of the non-diversifiable risk that this asset poses to our portfolio? The security market line is a graphical depiction of the capital asset pricing model. It reflects the required return for each level of non-diversifiable risk. So here we see non-diversifiable risk, or beta, is plotted on the horizontal, and the required return is plotted on the vertical. And we see that as non-diversifiable risk increases, the required return increases. There are some problems with capital asset pricing model. The first is that the capital asset pricing model relies on historical information, and historical information may not accurately predict future events. So it's best used as a rough approximation. It also assumes that markets are efficient. From a research perspective, when we're looking at this and we're calculating our beta, the beta is the market return plotted against our asset return. Our asset return is pretty easy to find. But the market return, what is the market return? Technically, it's supposed to be the return on all assets, even human capital, and we don't really have a way to measure that. So, in theory, the best way to measure the market return is the valuated portfolio of all assets that are available on the CRSP index. That index costs a fortune to have, and most universities do not have access to that. So, most researchers are going to strive to use the CRSP valuated index, but if that is not available, then they're going to rely on something that is readily available. Maybe the return on the S&P 1500. That certainly isn't the market return for all assets. Another problem is what time frame are you looking back at? So are you using 3-month historic returns, 3-year historic returns? There's just a lot of problems with the capital asset pricing model, but it is the best that we have.